When it comes to trading, it's important that you have a system that is profitable in all market conditions. A system that's profitable when the markets are trending, and also a system that makes money when the markets are consolidating. So today, we'll be discussing how you can create an all-weather system to ensure your profitability in your trading long term. So trading isn't as simple as finding the strategy online and then implementing that into your own trading full time. Market conditions change, and it's important to understand how you can make sure that this system is profitable in the long run. And there are a few simple steps and a few simple things that you should look to implement into your trading. And to start off with, it's diversifying your assets. So when it comes to Forex, the currencies are paired together, which creates an asset that us traders will trade. So most of us would know there's 8 major currencies and about 16 different major assets or major pairs within the links of those currencies. And then you've also got commodities as well. Each of these different pairs will move differently and have different market patterns. So it's important that you understand that these pairs will move differently, and it's important to diversify your strategy through implementing multiple pairs into your trading system. Now, what we might find is that the Aussie dollar might move completely different to the pound yen, and the Aussie dollar might be a lot more profitable in the system that you trade than the pound yen. But it might not always be the case. There might be certain times of the year when the pound yen performs better than the Aussie dollar, and this is the importance of diversifying. The saying goes, don't put all your eggs into one basket, and I definitely recommend doing the same thing when it comes to trading as well. So in my own personal trading, I trade 16 different assets. 14 of those are Forex pairs, and the other 2 are commodities, being gold and silver. And by trading so many pairs and backtesting all these pairs, I can understand that not all these pairs perform the same. There's certain pairs that are a lot more profitable than others, but however, by trading so many, it helps to reduce my risk and also helps to streamline and stop the plateaus that might happen in the highs and lows of your equity curve. Trading's all about making a consistent and sustainable profit in the long run. So by diversifying, not only you're minimizing your risk, but you're ensuring that your equity curve is a lot more stable than if you were just to trade one pair that's a lot more erratic. And of course, it's important to understand this, and the best way to understand this is through backtesting. Backtest your system that you've got and your rules in place across a couple of different pairs and just see the difference of the profitability and the returns of each of these different assets. However, this leads into my second point, which is correlation risk. So correlation risk is when you have too much of your capital in one particular asset. So as an example, let's say you have 4 trades on that all involve pairs with the US dollar. You might have gold US dollar, you might have the Aussie US dollar, the pound US dollar, and the euro US dollar, and you have 4 different trades on 4 different assets all in the same direction. Now, if something was to come out like a news release in regards to inflation or interest rate rises, and we're seeing a lot of that at the moment, against your current trade, you're going to take a significant loss on this trade because of how many different trades you have on at one particular time. It's why it's important to have rules in place in regards to correlation risk to avoid yourself from taking a significant loss that you weren't expecting to. Now, obviously, if this turns the other way and you have a news event that's positive, you're obviously going to make a lot more money. But like I mentioned earlier, the main focus of a trader is to protect your capital. And the best way to protect your capital is to have rules in place. So I highly recommend to have rules regarding correlation risk. Now, I personally trade between 1% and 2% on each individual trade. So I limit myself to only 3 trades in one particular asset at any particular time. And the way that I order this, it's the first come, first serve basis. So if I have 4 different trades that come on, the first 3 that fill will be the 3 that I'll be taking. And again, the best way to understand this is through testing. I've gone through my data and worked out exactly the best way to take these rules. And there are times when I've had 5-6 trades and they've all turned out to be profitable and I would have made significantly more money. But then when you look at the other side, when it doesn't turn out and you end up losing a lot more money. And when you take these large losses, they can result in you making a significant loss or even losing a potential prop firm trading account. And my third tip to ensure that you can create a system that is an all-weather system that can be profitable in all market conditions is to trade multiple strategies. Now, this can be treated the same way as having different assets. Different strategies will perform better at different times. The main market movements are either trending markets or consolidating markets, and certain systems will perform significantly better during trending markets. However, they won't perform as well or potentially return a loss during consolidating markets. But consolidation happens typically around 70% of the time when it comes to Forex trading. So it's important to have a system that works during trending markets and also have a system that works during consolidating markets. That way, whatever market conditions are occurring, you're still going to make money and your system will still be profitable in the long run. Now, you've obviously got to start somewhere, and I highly recommend if you are a novice trader just coming into the industry, just focus on perfecting one strategy first. But if you have been trading for a while and you're starting to notice the patterns of your equity curve just just like a roller coaster, up and down, and not creating that sustainable and consistent profits in the long run, I highly recommend creating another strategy or developing a second strategy that helps to supplement your first strategy to ensure that you can smooth out that equity curve. Now, I personally trade two different strategies. I'm looking to add in a third shortly as well. And these strategies work hand in hand. One is more of a continuation based strategy, whereas the other is more of a reversal strategy. So that way I'm able to take advantage of the different market conditions and have different trades aligning during different market conditions as well. So that's it, guys. There are my 3 tips in regards to creating an all-weather and all-purpose trading strategy. Have different systems in place, trade multiple assets, and ensure that you're not affected by correlation risk. Now, if you're able to implement all 3 of these into your own personal trading and into your trading plan, I guarantee you're going to see better results in the equity curve, less risk being taken, and overall more profits. So thank you so much for tuning in. If you did enjoy the video, please make sure you smash that like button, comment down below if you've got any questions. Otherwise, I look forward to seeing you next time.